The next market shift could either make you or break you. But what if I told you the investors who sleep best at night don't chase headlines? They follow timeless principles. That's exactly how Warren Buffett turned thousands into billions. In this video, I'll reveal 4 powerful stocks Warren Buffett has personally invested in. Stocks with wide moats, predictable cash flows, and serious long-term potential. We're talking about names that could anchor your portfolio for decades. Stick around because by the end, you won't just know what these companies are. You'll understand why they're built to last and how to use Buffett's strategy to build real wealth. If you're ready to escape the noise and focus on proven investing wisdom, tap that like button. Subscribe for more high-conviction stock breakdowns and drop your favorite Buffett pick in the comments below. Warren is as good at sharing insights as he is at sharing investments, so be sure to watch until the end. Apple isn't just a holding in Buffett's portfolio. It's his biggest by far. At one point, Apple made up over 40% of Berkshire Hathaway's entire equity holdings. So, why does Buffett love Apple so much? It comes down to one word: ecosystem. Apple has created a sticky, high-margin ecosystem of hardware, software, and services that keeps customers coming back year after year. From iPhones to AirPods, from iCloud to Apple Pay, each piece makes the whole stronger. Buffett has praised Apple's brand loyalty, pricing power, and massive cash flow. It's not just a tech company, it's a consumer brand with a fan base that behaves more like a community than a customer base. Apple also returns billions to shareholders through buybacks and dividends, a strategy Buffett loves because it increases Berkshire's ownership without lifting a finger. And perhaps most importantly, Buffett believes in Apple's leadership. He's repeatedly said that CEO Tim Cook is one of the best managers in the world. In Buffett's eyes, Apple is the perfect blend of tech innovation, brand loyalty, and financial strength. That's why it's his top position. Apple's strength also shows up in how it weathers downturns. During market volatility, Apple's cash flow gives it the ability to buy back stock aggressively, raise dividends, and continue innovating, all without overextending its balance sheet. That kind of financial fortitude is exactly what Buffett looks for when storms hit. And don't forget Apple's global footprint. In emerging markets, Apple's brand is aspirational. Even with higher price points, demand stays strong. Why? Because people don't just buy the iPhone. They buy into a premium experience that's backed by design, privacy, and service. Buffett has often said he doesn't understand all tech companies, but he understands consumer behavior. Apple is the bridge between both. So when Buffett calls Apple probably the best business I know in the world, he's not exaggerating. It's not just about the tech. It's about the moat, the brand, and the durability. That's why Apple continues to be his largest holding, by a long shot. Amazon is more than a marketplace. It's a global operating system for commerce, logistics, and cloud infrastructure. While many investors only see an online retailer, Warren Buffett saw something deeper when he finally bought in, despite the high valuation. Why? Because Amazon reinvests relentlessly. It sacrifices short-term profit for long-term dominance, and that's Buffett's language. The real gem inside Amazon is AWS, their cloud division. It's the backbone of the internet for companies, governments, and startups alike. AWS alone could be a trillion-dollar business. Add in Amazon's growing AI capabilities, its logistics network that rivals FedEx and UPS, and its dominance in digital advertising, and you've got a company with multiple, high-margin engines of growth. Buffett loves businesses that can't easily be disrupted. Amazon is so deeply embedded in our daily lives it's practically invisible, and that's its moat. One thing Buffett values in Amazon, despite his usual avoidance of low-margin retail, is its ability to dominate industries at once. While traditional companies succeed in one lane, Amazon wins in several: e-commerce, cloud, logistics, and even advertising. And yet, Amazon is still reinvesting billions into future growth, particularly in artificial intelligence, robotics, and same-day delivery. These bets may not pay off immediately, but Buffett respects long-term capital allocation. He knows Amazon is playing the long game. Critics argue that Amazon's valuation has always been high, and Buffett agrees. That's partly why he was late to invest. But when a company earns your trust, builds defensibility, and executes at global scale, sometimes you have to pay up. Buffett didn't buy Amazon for a quick flip. He bought it because it's become a backbone of the modern economy. And that's a business you don't mind holding. Visa might be one of the most lucrative companies on the planet, and yet it rarely makes headlines. That's because Visa makes its money not by lending, but by facilitating. Every time you make a transaction, Visa gets a cut. It's a frictionless, scalable business model with stunning economics. Its operating margin? Consistently around 60%. Its return on capital? World-class. In the digital economy, Visa doesn't need to build new factories or hire thousands to grow. It just needs more people swiping and tapping, and that's happening at scale, especially in developing markets where cash is rapidly disappearing. Visa is also inflation resistant. As prices go up, transaction sizes go up, and so do Visa's fees. It's a built-in hedge that Buffett would call elegantly simple. And here's something beginners miss. Visa isn't competing on price. It's competing on trust, security, and infrastructure. That's incredibly sticky. Buffett's investment in Visa highlights something crucial. He doesn't just chase trends. He bets on timeless infrastructure. In a world flooded with new fintech startups, digital wallets, and crypto hype, Visa continues to dominate quietly because it powers the rails beneath nearly every modern transaction. It doesn't matter if someone uses Apple Pay, a debit card, or a new banking app, Visa likely takes a cut. And that's what Buffett looks for. A business so essential, so deeply embedded in the economy, that it benefits from every transaction without taking the credit risk or needing a massive workforce. Even more impressive? Visa does all this while maintaining a fortress balance sheet. It has low debt, high margins, and consistent returns on equity north of 30% year after year. Buffett understands the power of habit. And once consumers are used to Visa, they rarely switch. Combine that with worldwide tailwinds from the digitization of money, and you've got a Buffett-style compounder hiding in plain sight. Insurance isn't sexy, but it's a cornerstone of Buffett's empire, and Chubb is one of the crown jewels of the industry. Chubb is a global leader in property and casualty insurance. It protects homes, businesses, tech infrastructure, and even cyber assets. It's built for risk and built to profit from managing it. Buffett has always loved insurance because of float. The money insurance companies collect from premiums before paying out claims. That float can be invested for years, often at attractive returns. But what makes Chubb special is that it's profitable on both ends. It underwrites exceptionally well, meaning it rarely overpays in claims, and it invests conservatively. That's exactly what Buffett looks for. Add in a consistent dividend, conservative balance sheet, and global diversification, and you have a textbook Buffett-style investment, boring, reliable, and profitable. Buffett's investment in Chubb also reflects a deeper truth about his strategy. He doesn't just buy stocks, he buys cash flow machines. Insurance companies like Chubb generate float, which gives Buffett more capital to reinvest elsewhere, often at better returns than competitors. That float acts like a zero-interest loan from policyholders, which Berkshire can then put to work. What's unique about Chubb is its ability to generate this float while still remaining highly profitable at the core. Many insurance companies lose money on underwriting and try to make it back through investing, not Chubb. Its underwriting is tight, disciplined, and consistently profitable, something Buffett has always admired. And while Chubb might not have the household name recognition of Apple or Amazon, that's part of the beauty. It flies under the radar, performs without drama, and delivers returns year after year. It's also internationally diversified, giving Berkshire exposure to markets beyond the US without taking on unnecessary risk. In today's uncertain global climate, that kind of balance is rare and valuable. Buffett once said, "In the business world, the rearview mirror is always clearer than the windshield." With Chubb, the rearview is rock solid, and the windshield looks surprisingly clear. So let's connect the dots. Apple, Amazon, Visa, and Chubb are vastly different businesses, but they all share key Buffett traits. Strong defendable moats, consistent free cash flow, smart shareholder-friendly management, low capital needs or high return on capital. Resilience in economic storms. These aren't trades, these are long-term holdings. You can build a portfolio around them and sleep well at night. Buffett's real edge isn't just in picking stocks, it's in how he thinks about money. So if you want to build wealth like Buffett, start with the mindset. Think decades, not days. Buffett doesn't get shaken by volatility, he uses it. He buys when others panic and holds when others flip. Do the work. He reads constantly. He studies companies like a business owner. He never outsources his conviction. Let compounding work. Buffett often says compounding is the eighth wonder of the world. Give it time. Don't interrupt it by jumping ship too early. There's a reason Buffett calls investing a temperament game, not an IQ contest. You don't need to be a genius to succeed, but you do need discipline. Most investors fail not because they pick the wrong stock, but because they panic at the wrong time. Buffett is famously patient. He waits years for the right opportunity, and when he strikes, he does so with conviction. That's something you can apply no matter how much money you're working with. Another key to Buffett's mindset: he welcomes volatility. Most people hate it. They fear red days and market corrections. But Buffett sees those moments as buying opportunities. As he puts it, the stock market is a device for transferring money from the impatient to the patient. And perhaps most importantly, Buffett doesn't try to be a hero. He stays within his circle of competence. If he doesn't understand it, he doesn't invest in it, no matter how exciting it looks. That's a mindset worth copying. Know what you own. Be willing to sit on cash. Study businesses like an owner. And understand that wealth is built slowly, not through gambling, but through consistency, clarity, and time. This isn't flashy, but it works. And it's how Buffett turned a few $1,000s into over $100 billion. Buffett isn't trying to win the game every quarter. He's trying to own the game over time. That's how wealth is built. Slowly, quietly, and with conviction. If you made it this far, you're already ahead of most investors. You're thinking long-term. You're focused on quality. And you're not here for quick flips. You're here to build something real. So here's your next move. Review these 4 stocks. Look at their financials, study their leadership, and decide where they fit in your strategy. If you got value from this, smash that like button. Subscribe for more timeless investing lessons, and share this with someone who needs a smarter roadmap to wealth. Until next time, invest wisely, think independently, and always stay curious.